Good morning, everyone. How's it going? Uh, I don't know if you can hear, but the building is creaking quite a bit, and there's some wind whistling around. The wind's just really picked up in the last 5 minutes, and it's a little noisy over here. So I apologize if you can hear that, and it's distracting. It's a holiday week. We're expecting a very quiet week, but we're still going to be here. There's still, obviously, the markets are still open. There's still trading going on, so there is still potential for price movement. It's just that we're not going to expect any really strong directional movement this week. So for the most part, we're going to expect choppy movement simply because it's the holiday week. So let's take a look. We did have some news over the weekend. The biggest news over the weekend was there was potential for a ceasefire, and then there's no ceasefire. So we'll see if that's affecting the markets at all. And our futures, it doesn't look like it's doing anything. So this is insignificant, completely random in the S&P 500, NASDAQ, Dow, all of them, VIX, 10-year note, everything. Everything is just super flat. The only thing is crude oil up a tiny bit. I still wouldn't call that significant. So really nothing has changed over the weekend. And going into a holiday week, that's not too surprising. So this might be kind of short as we look for what's going on in the markets. As we just quickly review in the markets overall, we're going to look for the bonds to give us a clue, because the main driver over the last 2 weeks and what caused this huge run up in the markets was the expectation that we're done raising rates. The Fed is going to pause, and interest rates will be where they are. So that was taken as extremely optimistic news for the markets. So actually, what we should probably do is take a look at what's being priced into the bond market right now. So in December, with no surprise here, we have about 100%, 99.8% probability priced into the bond market that there's going to be zero rate hike, and it's 0.2% that we're coming down. So these people, they're super optimistic. I don't know who's thinking that it might actually come down a little bit at this point. There's really nothing to support that. The Fed hasn't said anything close to that. There's no data to support us actually lowering rates. Why does the Fed lower rates? It doesn't just randomly lower rates, and it doesn't just randomly push up rates. The default mode for the Fed is to do nothing. So when you look when there's normal markets, normal economy, normal operations, the Fed does nothing. The rate stays the exact same. The only time we start raising interest rates is really to combat inflation or an overheated job market. So the Fed has a dual mandate. They need to keep inflation at a certain rate. At this point in time, they've targeted 2%. And it's been that way at least for the last 20 years or so, when there was a big study that came out that 2% was the ideal inflation rate to keep economies going and keep them stimulated. So as of now, and until some academic report comes out and says otherwise, they're probably going to continue to target 2.0% as their target inflation rate. Unemployment is the same thing. If too many people are employed, then that's an indication of a stagnant economy. And then if too few people are employed, that's an overheated economy. So they have a target unemployment rate as well, which sounds kind of cruel, right? They actually want a certain number of people constantly unemployed. Don't ask me philosophically, it doesn't sound great, but economically, that's their target. That seems to keep, or at least they believe that keeps the economy going very strong. So they have those two mandates, and if everything's going perfectly, there's no reason for them to change interest rates. When we go out into January, what we see is that, again, almost 100%, chance that we're going to keep the rate the same. That's not surprising. And a 2.1% chance of us raising the rate. That's kind of interesting that there is a very small pocket that's pricing a probability of us actually moving up in January. So the idea is, even though it's a very, very tiny percent, there's this small probability that we're not done, that inflation is still sticky and it's not coming down the way we want it to. When we get into March, this is really interesting. So remember what I just said about the Fed doesn't move interest rates for no reason. We've got this 30% priced in that we're actually going to lower the interest rate. So either participants in the bond market don't know how the Fed works, or for some reason they believe that there is a reason for the Fed to start stimulating the economy in March. So that means sometime between January and March, in these 2 months, not even 2 months, 1.5 months right here, they somehow believe that the economy is going to start deteriorating so quickly that the Fed is going to actually start raising rates. That's kind of interesting. And that doesn't sound very realistic to me. That's only a month and a half. So how much data can we have to actually support that? And how much does it have to suddenly change over that month and a half in order for us to change this? And then if I look into May, there's actually a 13% priced in that we're going to lower rates by even more. So we're over here. They're pricing in almost a 50% chance that we're going to lower by 0.25 basis points. And then a 13% chance that we're going to lower by half a basis point. That is a really fast move. We have to remember that what we experienced in the past year or two with the Fed raising rates, that's historically by far the fastest they've ever raised rates before. And if we're going to start decreasing at the same pace that we've been increasing, that is a really extremely strong stimulating factor in the stock markets. So either we're expecting an extreme deterioration in the economy over these few months right here, or the bond market is there's a little bit of insanity going on. When I go over here and I look at TLT, this giant move upwards has been pricing in not only that we're going to stop raising rates, but we're actually going to lower rates in the first few months of 2024. And like I said, the Fed doesn't just randomly pull down rates. They always say, hey, we've raised rates and we've been raising rates for a couple of years and we've been raising rates for so long. And now that we don't have inflation anymore and things are looking good, let's start lowering rates again. There's no, they don't do that for no reason. The only reason we're going to lower rates is for stimulating the economy. So that means these guys over here in the bond market are probably, I could be wrong, they could be right, but it looks to me a lot like they're way, 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 way too optimistic. And this move is way too exuberant. That's irrational, extremely irrational. So at some point in time, my expectation is that this is going to start pulling back. And this is, since interest rates are basically the only operating factor in the market right now, we don't have huge economic news, I don't think. We have the FOMC minutes, but that shouldn't, everyone sort of knows what they're going to say. If everyone has 100%, 99.8% conviction in that rates aren't going to change. So there shouldn't be anything surprising right here. And nothing really for the rest of the week. Our earnings, for the most part, are done. We sort of know, unless some weird wild card event happens in the news that is completely unrelated to Ukraine and completely unrelated to the Middle East, then we don't have that hitting our radar. So really the only thing that's driving these markets right now is this interest rate. And at some point, when we realize that we are way too over exuberant, or the Fed goes, no, we're pausing, we're not going to we're giving a very clear signal to the market that we're not going to lower rates, all of this enthusiasm will start to be undone. And finally, that would be the stimulus for a pullback. And if that's the case for the pullback rather than technicals, if we get a technical pullback, that's to the EMA 8, maybe down to this blue line right here for the MA 90 where we broke out, and we would fill this gap. If it's interest rate driven, because the markets wake up and realize that we are way too optimistic about not just a pause in rate hikes, but a lowering in interest rates, then this will pull back a little bit deeper. So possibly down to that MA 50 and maybe as far as the MA 200, depending on how high it's risen by the time we get that pullback. So we'll see. So that everything that I've been seeing in the past week or two where I'm saying we need a pullback, we need a pullback, we need a pullback, that could be the stimulus. When the bond market starts to wake up and realize, oh, we were way too enthusiastic. We've been pricing in a lowering in rates when really there's no reason to believe that that's going to happen at this moment in time. So this week, though, for now, we're just going to, if anything happens, I kind of doubt that happens this week. So if we have a pullback, it'll be a technical pullback into the EMA 8, maybe into this big green line right here. And otherwise, we're just going to expect chop sideways. If we are going to day trade, because the markets are going to be much thinner this week, it's going to be very difficult to day trade anything that is not extremely liquid. And because we're not expecting prices to really move anywhere, we're expecting sideways movement throughout the week, there's not going to be a lot of trading range necessarily inside the market. So it could be a tough time to day trade. So my recommendation, if you decide to day trade, is to take short movements and just be out. Don't expect runaway trends this week. So if there are large price movements this week, they're most likely going to be gaps. There's most likely going to happen overnight, not during the trading session. So that means the money to be made is in holding from one day to the next, not actually during the trading session. So it may be better for you to adopt your day trading into overnight trading, meaning maybe you trade in the last hour of the day if you get a strong indication of direction. So for example, if I get a run up in prices at the end of the day in the last hour, or especially the last half hour or 15 minutes, and I see a strong surge upwards, I may choose to go long into the close and see if we gap up tomorrow morning, and then in the morning close that trade, rather than try to day trade and capture movement during the market session, because most likely you're not going to get a huge amount of movement. So if I go to last year in November during Thanksgiving weekend, you can see gap. And so these 2 days it did move. Well, I need to figure out when Thanksgiving was. So this was Wednesday, this was Thursday, this is Tuesday, this is Monday. A gap right here. And then Tuesday, Wednesday, we got a somewhat, you see, this was the normal range the week before and 2 weeks before. And then we started to get, 2 to 3 weeks before. The week before we started to get quiet, and these bars are about the same as these bars. So we got normal trading range Tuesday, Wednesday, Friday, almost zero movement. And then over the weekend, gap down, movement down. Okay. Let's look at the previous year. So we've got Monday, Tuesday, Wednesday, all same size bars, about the same. So we got decent range. We got normal range on these days. And then we had a gap down from Wednesday to Friday, gap. So the majority of your movement is most likely going to be in gaps rather than in the trading range of the days, although that wasn't entirely supported in 2021. Let's see in 2020. So we've got Monday, no real trading over here, gap up to Tuesday, no real trading range on Wednesday, and then a gap up and on Friday. And so that's what I'm talking about. You may get some normal days, but most likely most of your profit is going to be in gaps this week. So just realize if you're day trading, you're like, oh, it's going nowhere. It's not doing anything, not making any money, or I don't have these large movements where I can capture enough profit. That's why. It's because your liquidity isn't enough in the markets. And most likely, if you're going to create a large amount of profit, it's going to be overnight. So holding overnight. That's going to be it for today. That's my best advice for this week is just be careful because liquidity is low. There is potential for price gaps, especially the less liquid stock that you're looking at, the more potential for price gaps and choppy movement and getting faked out. So I would stick to highly liquid, so indices, index funds, and extremely liquid stocks like Tesla, like Apple, like Microsoft, the really big names with huge amounts of volume. So that's it. I'll see you in the aftermarket session, and we'll see just how active we were in the markets. All right, have a great day, and I'll see you in the afternoon.